Our topic of discussion today is God's analytical pattern or gaps. I consider gaps as God's gift to traders, both swing and intraday, enabling them to make a great deal of money by using this simple pattern. Now, a gap is defined as a white space on the chart where no trading has taken place. The cause of the white space is an imbalance in demand and supply between two trading sessions, which is why gaps are best traded on the daily time frame but can also be traded intraday based on special criteria. I would strongly recommend that you see this entire video from start to finish, which will change your entire perception of gaps from the complexities which have been put onto the internet on different kinds of gaps and bring them to the simplest possible form of trading. Now, what exactly is a gap? True gaps are only of two kinds, an upward gap and a downward gap. An upward gap has today's low more than yesterday's high, and a downward gap has today's high less than yesterday's low. I will show you this on a chart so that it will become easier for you to understand. Please remember that at no point in time you are going to predict that there is a gap which is going to occur on the chart. Only after you see a gap, which is after updating today's data and which you can determine using a scanner, will you be trading the gap the next day. What are gaps? Now, this is price, this is time. If today's low is higher than yesterday's high, we call it an upward gap. If today's high is lower than yesterday's low, we call it a downward gap. The trading with a gap is very, very easy. If we see an upward gap after updating today's data, then on the next day, we buy above the high, keeping this high as the stop loss. If we see a downward gap, we go short below this low, keeping this low as a stop loss. It's as simple as that. Now, with this definition of gap, let's understand the categories of gaps. Upward gaps and downward gaps fall into 5 different categories, which are common, breakaway, continuation, exhaustion, and island reversal. A common gap is a useless gap. It occurs in thinly traded shares and is of no use whatsoever to any trader. The only two kinds of gaps which can be traded are the breakaway gap and the continuation gap. What is a breakaway gap? A breakaway gap is a gap which is formed in a direction opposite to the earlier trend and it kickstarts a new trend. A continuation gap, on the other hand, is a gap which is formed in the same direction as the earlier trend. Both are traded in an identical manner. A criteria to be kept in mind is that a gap is a white space which is formed on higher than normal volume and which does not close within 2 trading sessions. Now, this 2 is a subjective number, but after seeing thousands of charts, 2 has emerged as a highly probable number for a chart to be successful in order to be traded. An exhaustion gap is deemed to be a continuation gap because a continuation gap can occur several times in the formation of a strong trend. Please remember that 4 or more continuation gaps can cause a trend to weaken. When a gap which is deemed to be continuation gap is covered within 2 trading sessions, it is called an exhaustion gap and it signals the end of a trend. Finally, there is something called an island reversal, which is basically a breakaway gap which is covered by an exhaustion gap. It is a rare pattern, but of late it has appeared twice in our current movement of the Nifty. Here we have a downtrend. Now, the downtrend evens out, stops. Maybe there is a candlestick reversal pattern somewhere near the downtrend. And then we have a gap in a direction opposite to the earlier trend. This is called a breakaway gap. A gap which occurs on the downside and which is a breakaway gap is called a breakdown gap. As the trend progresses, there will be a resting period which may be punctuated by a continuation gap, and multiple continuation gaps can occur. Ultimately, there will be a continuation gap which, though deemed to be a continuation gap, will get quickly covered and becomes an exhaustion gap. Now, here is an example how in Nifty, a breakaway gap could have given you big profits. Take a look at this gap. We were in a downtrend, a gap occurred in the opposite direction. Here we were in an uptrend, a gap occurred in the downward direction. Both of these are breakaway gaps. look at the swing which these gaps gave you. So this example itself should illustrate to you the power of gaps. That said, let us now move on to the characteristics of gaps. Now, gaps have certain characteristics which you must keep in mind, which is, to begin with, they act as supports and resistances when there is a contra trend movement. So if there is an upward gap, and if at a much later date the market comes down to that level, that upward gap will act as a support. Similarly, if there is a downward gap and the market for some reason comes back to that level, it'll be treated as a resistance level. An old wives' tale, which is promulgated by a lot of technical analysts, is that every gap must be filled. Nothing could be further away from the truth. Every gap will not be filled. By coincidence, certain gaps will get filled, but that is more an exception than a rule. In most cases, gaps can remain unfilled for years on end or may never ever be filled. Also, gaps are trading tools. Why? Because they are absolutely crystal clear black and white tools which give you exact entries and stop losses. Trading tools act best when they are combined with other trading tools like candlestick reversal patterns or chart patterns, or analytical tools like trend lines or Fibonacci levels. Now, when I talked about higher than normal volume, in the case of futures, a volume which is 10% greater than the 5 days average volume, or in the case of equity, a volume which is double the 5 days average volume is considered to be higher than average volume. Now, how do we trade with gaps? Now, here we have an upward gap. How do we trade this gap? We buy above this high, keeping this level as the stop loss. Similarly, we short below this low in the case of a downward gap, keeping this level as the stop loss. As simple as that. There is no ifs and buts. There is no other complexity. This is the only way to trade a gap. Now, this method which I just explained to you is how you trade daily gaps. If you wish to trade gaps on an intraday chart, which I will be showing you with examples. So now that we have understood how to enter into a trade using an upward or a downward gap, and we have the corresponding stop losses for both of them, the only thing which remains is how do you take out the target for a gap. The target for a gap is taken out based on whether it's a breakaway gap or a continuation gap in a manner explained in the following slide. Now, here the thing to understand is that the risk reward ratio must be kept in mind before entering into a trade. And every trade, as I've been going on telling you, must be executed with precision and discipline. Here we had a bullish breakaway gap, which gave you a huge move, followed by a correction. And then we had a bullish continuation gap. As you can see, the gap almost met its target. It was covered because of huge volatility on account of the election results. But at the same time, even before that happened, it gave you a tremendous profit. Here we had a bullish continuation gap, which very comfortably met its target. Here we had a breakdown gap. This breakdown gap was confluenced by a morning star and which ultimately also became an island reversal. Here again we had a bullish island reversal which gave an almost vertical move in Nifty. Again, let's take a look at another chart of Nifty where we had an evening star which preceded the breakdown gap, and then we had this demand line. This morning star came at exactly the demand line, giving you the first indication of an impending reversal. This reversal was fully confirmed when this bullish island reversal came here, followed by a tremendous move in Nifty. Now, although it looks small, this is a huge move in Nifty, going into more than 1,000 to 1,500 points in the index. Here again, we had a vertical downward move, which was followed by a hammer pattern. This hammer pattern caused the market to stop falling almost again near the demand line, and then it was followed by what I call a FOMO gap. Remember, all vertical movements in the market are a result of fear of losing money in this case because most of the market was bearish and was therefore short on the market, and short covering has caused the market to go up, coupled with the bulls now jumping in and causing the market to go up further out of fear of missing out on a huge bull run. Finally, let's take a look at a third chart of Tata Motors, where multiple gaps have been shown to you. Here we have a breakaway gap followed by a continuation gap which comfortably met the target. Here again a bearish continuation gap which again met the target. So gaps are a phenomenal trading tool. Now, I've said this several times during this presentation, but let me repeat it again for you. They are God's gift to traders. There is no confusion in identifying a gap, and trading a gap with the correct discipline can yield enormous results for traders. Coming now to trading with gaps on an intraday basis. Till now we have covered the daily trading of gaps. Now let's come to intraday trading. Now in intraday trading, let's take a look at the 5-minute candles. If the first 5-minute candle of a day is creating a gap above the last 5-minute candle of yesterday, and after the second candle has been made, the lower low of the two candles is above the high of the whole day yesterday, buy on the opening of the third candle, keeping the high of yesterday's last candle as a stop loss. And if X is your stop loss, entry plus twice X is your target. If you look at the numbers which I have given on the screen, you will see that within a few hours, this target was comfortably met. So this is a phenomenal intraday trading system, but like all intraday systems, it is fraught with risk. So you must be careful when trading this system and take the advice of a good professional portfolio manager before you actually enter into a trade. Now here is an example of a failed system. It is my duty as a person who is telling you about a system to show you the pitfalls of the system also. Here, let me not send you into the market with stars in your eyes, that here is the system which will always work. No system, no matter how vociferously somebody on any video is telling you, is going to work all the time. Every system is going to fail at some time or the other, which is why we have stop losses in place. Now in this case, the system failed. One of the reasons which I can straight away tell you for the failure is that the magnitude of the gap was extremely high. Very high gaps have a greater probability of failure than smaller gaps. Now, there may be an argument that very high gaps indicate very good news, but remember that most of the news is already built into the price, as a result of which the price has already been discounted. Therefore, trading large gaps is not highly recommended. There are many people who try to fade or go against a large gap. My suggestion to you is don't do that. Trade only gaps which are reasonable in size in the direction of the gap. Do not try to fade a gap. Every book will tell you and explain to you how to fade a gap. Experience is telling you not to fade a gap, but to trade in the direction of the gap. Here again are some more examples of gaps which worked. Here is the gap on the downward direction in Indus Tower, and which met its target as per the parameters given within a few hours. So gaps may be traded both in the daily mode as well as the intraday mode. However, my suggestion to you would be to trade gaps on the daily charts rather than the intraday charts. Those who are trading only intraday can use this as one of the systems to trade their intraday trades. Please remember that this is an educational video. The purpose of this video is to save you years of learning, which you will get by looking at videos, other videos, and trial and error. This is giving you everything exactly the way it should be. And using the methodologies explained here should yield enormous profits to you in the long run. Every trade will not be right. If you have seen my earlier video on how to set up a trading desk, the methodologies explained there must be followed. Most good traders trade to get their trades right. Anything which you do right in life automatically gives you money. You play cricket well, you make money. You act well, you make money. You trade well, you automatically make money. Focus on your trading rather than the money, which I've already told you in an earlier video. You must write off at the start of your trading career. By writing off your initial trading capital, you remove the sentimentality attached to the money which you are putting into your trading capital and become objective to the profits and losses made in a trade. You're not happy when you make money, you're not sad when you lose money. It becomes a business for you. I hope that this exposition on gaps, God's analytical pattern, will help you to achieve this objective in your trading career. We hope that this is beneficial to you and expect to see you in future videos. Have a good trading week and we'll catch up soon.